Economy edition. In seconds from now, we should be getting the August CPI number, inflation number. It's an all-important number because the last number was a fairly scary 7.44%. The CNBC-TV18 poll indicates that the August CPI is also likely to be a little scary, if you please, for want of another word. 7.08% is what our poll threw up. We will have to wait and see. We will also get one of the production numbers, the industrial output index, which will be for the previous month, the month of July. There, the expectation is that growth would have come in at 5.5%. Okay, the CPI number is here, and it's such good news, 6.83%. I mean, this is a huge boost to the bond market, and of course, a big relief to the CPI, to the RBI and the MPC as well. So perhaps a further tightening will not be needed. We are getting more numbers. So 6.83 against our poll of 7.08 and against the July number of 7.44. That's, over a 50 basis point fall in the inflation number. That's extremely positive. Food has contributed in a big way. The food price inflation is 9.94. It was 11.5 in the month of July. So it's fallen as well. The CNBC-TV18 poll was a little north of 10%, 10.08. So at 9.94, that's also at least 10 basis points, if not a little more, 15 basis points lower than we thought. So this is extremely important. The industrial output growth has also come in a tad better than we thought at 5.7%. I think the CNBC-TV18 poll was 5.2%. Now, this, I must say, is an extremely exhilarating set of numbers because inflation is slightly lower than what our poll threw up, and industrial output is a little higher. So growth better than expected and inflation lower than expected. You can't ask for anything better than that. Food price index is down 0.7 month on month. So that clearly is contributed by tomatoes in particular and vegetables in general. The cereals and products index is still up. That's up 1.4% on the month. Last month itself, we had a 13% inflation in cereals, and now it is 1.4% up on the month. That's not looking good. So clearly a large part of the fall has come from the vegetable index. The vegetable index is down 5.9% on the month. So one should expect a fairly sizable year-on-year fall as well. Pulses and products is up 1.5%. Here come the government's problems. Two things that it will not want. Why government? Common man's problems. Both cereals and pulses up 1.5% month on month from already 13% YOY levels in the month of July. So while we have relief in vegetables, we do not have relief across the board in food prices, certainly not the more stickier element like, cereals. That's always a scary part. There are more numbers coming in. Clothing and footwear index is up only 0.2% on the month. That's a saving grace. So my sense is we are going to get a very benign core inflation. Core inflation, our poll said 4.8 versus 4.9 in the month of July. But let's see, the numbers are coming so so benign. Miscellaneous index, all services put together, is just 0.3% up month on month. CPI clothing and footwear 0.2% month on month. Housing index up 0.6% month on month. But it looks like we may have a fairly benign core inflation number just going by the miscellaneous numbers that we have got so far. Let me now come to the year-on-year numbers for the various items. Okay, we have cereals and pulses up about 11.85. Okay, it was 13% last month. So it's, although there is a month-on-month jump, it looks a little benign. Vegetables are the ones that's helping a lot. It is still 26% higher. But if you remember last month, I think it was about 50% higher. So this is looking a little benign compared to that. Pulses are up 13% year on year. Like we told you, it's 1.5% higher month on month. Fruit is benign, only 4% higher year on year. Oils and fats are still much lower. Remember last year, we were wincing under higher edible oil prices because of the Ukraine war. It's edible oil still down about 15% year on year. Milk and milk products, it's beginning to look a little better. It's up 7.7%. From Jan to June, it was up well over 8%. So now the base is starting to catch, and perhaps we have seen the peak of milk prices that also could have added to the food inflation number being a little more benign. So that's it on food prices. Spices, of course, are still high at 24%, but that weight is very small. Let me just read out the miscellaneous numbers, all the services numbers. I already told you how the housing is up 4.3%, fuel and light up 4.3%, so both those are 4.3, clothing and footwear 5.5. But coming to the services, household goods and services is up 4.75, health services, that's expensive, up about 6.2, transport and communication has fallen, up 2.47, recreation and amusement up 3.99, education up 5.46, and personal care and effects, that's up substantially at 8.12. I'm still waiting for the core sector calculation, which will probably come from Cogensis or some such place before I go to the experts. And very quickly, let me just swerve to the inflation, to the industrial output number. Like I told you, it's 5.7, so a very good number. Mining 10.7, manufacturing 4.6. But that's still better than 3.1% year ago. Electricity, very good at 8%. Capital goods, 7.6. Sorry, primary goods is 7.6. Capital goods is 4.6. That's not as impressive because we've had very impressive capital goods numbers. That's come down a bit to 4.6. I don't know if that's the beginning of worry. Infra is up 11.4. That's still doing well. Consumer durables, again a minus number. For what, the third month running, minus 2.7, and consumer non-durables up 7.4, which is a positive. Okay, I think I've blurted out a whole host of numbers. Let me welcome my guests, Aditi Nair, Chief Economist at ICRA, Nikhil Gupta, Chief Economist at Motilal Oswal Financial Services, and Rupa Negere-Tsure, Chief Economist at L&T Financial Services, and of course, one of the authors of the inflation targeting report led by Urjit Patel. Rupa, I will have to start with you. Okay, we are also being joined by R. Sivakumar of Axis Mutual Fund in a bit. But first to you, Rupa, what's your sense of this inflation number, 6.83, better than expected?
Certainly, it's better than expected, but I think we are looking at everything in relative terms. We should not forget that RBI's tolerance, upper tolerance limit is 6%. So it is much higher than that. So, they will still wait and see how it pans out. Because as they have been saying, they are able to control now inflation through a lot of supply side measures. But I feel the way now we are seeing, inflationary pressures building up in cereals and products and pulses. It has potential to make the whole phenomenon more structural rather than cyclical. And RBI will certainly remain vigilant about that, given the, unevenness in monsoon rainfall and the fact that, water reservoir levels are depleting every passing week. So, it's not just the concern about the Kharif, but at this stage, they will even think in terms of the outlook for Rabi crops.
Okay. No, your point is taken. Reserve Bank has said in the past that while vegetable inflation is transitory, cereals inflation does tend to be a bit sticky. Let me also welcome Madhvi Arora. I'm sorry I missed you out, Madhvi, but just coming to you in a minute. Aditi, your first thoughts, is the inflation picture looking better than you feared? I mean, it's not per se a good number, but is it better than you feared?
Thanks, Latha. Certainly, it has come in 10 basis points below what we had penciled in for today. So in that sense, it is a relief. It's confirming that at least tomato price spike as expected was transitory. But there are so many looming concerns on the food inflation side that it's hard to really be too optimistic with how things are evolving. We are expecting the next CPI print to be below 5.5%, but even with that, the quarter as a whole is going to exceed the MPC's forecast. So caution is not going to go away from their tone anytime soon. And I completely agree with Rupa that we are moving from a crystallization of all the fears that we had for the Kharif crop to now beginning to get quite concerned about what lies in store for Rabi. So not the best of food inflation situations overall, but of course a relief for now that the core components have come in below what we were expecting.
Okay. Okay. My only point is that when I was taking the poll, all of you knew about the El Nino, all of you knew about the reservoir levels, and we still have a number which is a good, 25 basis points lower than my poll. And that goes for Nikhil, you as well. Your number is very close to our polls at 7.1, and this is like 27 basis points lower. Will you redraw your inflation forecast for the year? Are you less worried?
Hi, Latha. So yes, we are happy that the number is below 7%, but if my understanding is correct, it is entirely because of vegetables.
Yes.
We penciled in a deflation of 1% month over month in vegetables, but daily prices were showing higher inflation. I think it's very difficult to forecast because even when the numbers are out on daily basis, because last month daily prices were showing minus 50% and in CPI it was minus 35%. So we do not get data for all vegetables, and that is why it is so difficult to predict it. And that is why, although I mentioned 7.1%, we always said there is a downward bias to those numbers. And there is no as such relief from the future month numbers because it is entirely because of vegetables. Okay. It is very clear that pulses, spices, crude oil prices, these commodities are seeing higher inflation. Cereals have been in double digits and will remain high in the foreseeable future as well. So actually, we have revised up our inflation numbers considering what happened last month, that is July. And even though August is slightly lower than this, our inflation now is higher than what we were expecting a couple of months back for this year. Okay. And we do not see, you haven't asked, but for September, we do see inflation at somewhere close to 6% or so.
Oh, 6% for the full year.
For September.
For September. What's the full year number? 5.4?
For the full year, we are close to 5.5, yes.
5.5, okay. Madhvi, what would your thoughts be? Are you going to revise your number? Where do you stand at in terms of full year now, and will you revise it?
So honestly, as Nikhil also mentioned, that there's a lot of volatility in the data. Every week is a new week for us in numbers. At this point in time, we are tracking next month's data close to on 6.1%. We'll also have the effect of lower LPG prices, which will be felt in the month of September. And also the vegetable prices are tracking much lower than previous month, obviously led by tomatoes, while onions are still a problem. And as most of the panel guys suggested, we are seeing perishables being non-perishable being still a problem. The persistence of non-perishables, which is led by pulses, cereals, and spices to that extent, it's probably going to be continuing as we get into the latter part of next quarter. Okay. So I think next month we are looking at a 6.1%. Overall for the year, I still think that we are close to a 5.3-ish. And I think core inflation would be undershooting headlines by roughly 40-50 bips this year.
Okay. Got that. So the RBI's inflation number for the current quarter will have to be revised higher anyway from what they told us in June. What they told us on August 10th. But we'll come to that in just a minute. Sivakumar is really the man of the moment because the bond market should be exhilarated. They were all preparing for a 7% plus number. This is 6.8. So, Shivakumar, do we get some bit of a rally in bond prices, or will you all keep looking at the US 10-year?
There's a lot to unpack here, right? I mean, I think, firstly, absolutely, this is a good number. I think markets were expecting a range in line with your poll, somewhere a little north of 7%. The fear would have been there if this is printed at 7.5, right? So clearly, the fact that it's printed below 7 will give a little bit of comfort to the market. But I think the markets, as always, forward-looking. This month-on-month volatility in vegetable prices. What can the MPC, what can interest rates do? to react to 1 month's vegetable trend. Right? So you have to look at a little bit medium term. And I think that's the worry the panel has expressed on things like reservoir levels leading up to fears that we may develop over a period of time. What will happen in the Rabi, etc. So the persistence of inflation, I think, is going to be more of a problem than this, couple of months of spike in inflation. I think if it becomes a persistent problem by the end of this year, early next year, when the Rabi crop comes to market, we have a serious issue at hand. Because I think from a market's perspective, as we've previously discussed, there is no rate cut expectation being built up at least for the next several months into middle of next year. So it's not that the markets are going to be disappointed in some sense with what RBI is going to do. But if inflation remains high going into the new year, we may need to reevaluate what monetary policy will look like middle of next year. And I think that will then start to worry all of us. I think that is going to be on people's minds as we go every month forward from here. Certainly the Fed and other factors are in play, but come on, 10 years at 727 quarter levels, a lot of those risks are priced in.
Okay. Well, already the one-day call and the tripartite repo are all, above 6.5. Today, I think 6.7 almost, 6.68 thereabouts. Do you think Reserve Bank relents in terms of giving us more money towards September 15th, as was expected, and we see it move towards 6.5? Now that you're not crazily worried about inflation, will they allow it to come closer to 6.5 and occasionally below?
It seems to be, this ICRR and the fact that they have let it run forward suggests that they are more comfortable if the overnight rate starts moving closer to the MSF than if it stays at repo, and certainly very, very uncomfortable if it dips below repo. So the bias is to keep rates higher. So this is basically a way of kind of signaling a hike or hiking without hiking, right? So I think that is very clear that even, and this is an off MPC decision. So it's not that the MPC really feels that they need to make a repo rate decision. This is more about the RBI then wanting to keep liquidity tight and rates probably hugging the MSF to sort of push a downward pressure on the economy. So I think I don't think the RBI wants to hike because that's too strong a message, but this is a kind of an indirect way of keeping liquidity tight.
No one's talking of hike. I mean, they won't do that perhaps, but...
I would say that keeping liquidity tight through this kind of a liquidity, the ICRR type of a
and
measure.
still closer to 6.75, you think?
Yeah, if you're pushing it to 675, for practical purposes, if that is going to be your new benchmark, it's almost as good as. So I think the signaling effect is not there as much as a repo hike, but the practical effect in terms of pushing rates high. Right?
To be fair, the weighted average is 6.75 even today. It's only the close is 6.67 or 6.63. Otherwise, the weighted average, RBI has effectively pushed yields by about quarter basis point. Let's dwell a little bit on the growth number as well. Not that it is the best of growth indexes that you economists track, but nevertheless, 5.7, does that look like a good number, Nikhil? Industrial output for July.
Yeah. So, Latha, we were expecting higher number, especially considering the fact that core growth was 8% plus, and there was this base effect as well. Last year, this month was 2% as against much higher in the previous month.
Okay.
So we were expecting close to, I think, 8% IIP this month. So we are disappointed, but I understand the consensus was much lower and it has turned out to be better than consensus. So I don't think markets have anything to worry about. But I still believe that for the next 3 months, IIP could turn out to be much better than even July numbers because of the base effect and because we have festive season coming up.
Yeah, and there's electricity is done very well, and we see very clear policy efforts also to keep electricity in ship shape. That perhaps also is helping. Rupa, what have you made? Okay, I just wanted to tell you all the core inflation 4.8 is what the Cogensis calculation is. I have got another economist telling me, no, it's 4.86. So core has dipped, but not by a great deal. It's not a seminal fall. It's just crawled lower. Well, Rupa, you want to say anything about core and then, of course, IIP?
Yeah, core is in line with my expectations, and I think that definitely the monetary tightening so far has played a great role. So far as IIP is concerned, Lata, definitely this is a good number, but this was expected because we had seen, very good growth print for core industrial output, which has a weight of 37 to 40% in IIP. But there also, you see, we are seeing a particular pattern because this growth is primarily driven by central government's capex spending, and that's why you are seeing good growth numbers for infrastructure, construction, primary goods, etc. And we are also seeing the small scale and medium enterprises which are part of the supply chain for these infrastructure industries. They have also been doing well. But when it comes to other sectors of manufacturing, like consumer goods, etc., I'm clearly seeing stresses in urban consumption. And what economists have been talking about, the K-shaped recovery, I think it's getting reflected very strongly. At the higher end, we are seeing good demand, but if you look at the typical consumption basket of middle class or low middle class people, then definitely there is a shrinkage of consumption. So you are seeing, for majority of the months in past 1 year, we are seeing consumer durable growth in negative zone. And consumer non-durables, which is a good proxy for rural demand, there now the picture is very uncertain because of very skewed monsoon rainfall. And most of the sectors and industries whose growth is driven by rural demand, they have already started giving caution on that front, such as FMCG or auto or even consumer durables firm, which have a very large exposure to rural markets.
I agree with you, but at the moment, the consumer non-durable number is good at 7.4, but this is a huge base effect. It was minus 2.9 year ago, same month, and therefore the July number technically would actually have been up only 3%, but because it is adjusting for a minus 3 of last month, year ago, it just looks like an impressive 7.4%, but worries are taken on board. Aditi Nair, will you change your inflation number and your growth number?
So, Latha, inflation for the full year, we're at 5.4%, and since the growth number was only 10 basis points below our expectations, so that's really going to have a negligible impact on our full year number. So, not changing that. On the growth side, the IIP number has come in well above our 5.1% expectation. And if we look at the high frequencies, then we do expect that the momentum is looking stronger for the next month, and we're expecting a print between, I would say, at least 6 and 7% for the subsequent month.
Okay.
Overall, I quite concerned about a couple of factors that could lead to a slowdown in growth in the second half of the year. The monsoon and its wide-ranging ramifications we've already talked about. That's certainly going to make rural demand quite cautious, pull down agri growth itself, and have an impact on the downstream sort of industries and demand. And also we are somewhat just watchful that higher government spending in the earlier part of the year it's probably an attempt to make sure that the budgeted targets are not missed by a wide margin. But possibly this does mean that we should be prepared for a slowdown in spending towards the end of the year as a model code of conduct comes into place.
Oh, absolutely. Absolutely. Aditi, there is a special session coming up. I wouldn't be surprised if there's something on elections over there. Something that hints to advancing the election, and then we have, the whole budgetary spending would be another math altogether. So let's not even get there. But at the moment, capex is a little lower, but infra is very good, indicating both state and central government spending. Madhavi, last thoughts. We are just winding down the show. Anything that you want to comment on in terms of industrial output or inflation?
Yeah, I think on inflation, we are not changing our forecast as yet. We are looking at around 5.3 for the year on headline. And for core, again, we're expecting, somewhere close to a 4.7%. There could be a marginal upside there, given the fact that this month's core has surprises from the upside. But I think overall, one has to reckon the fact there has been a consistent, slower, persistent overall core inflation getting relatively easy in second half of the year, and I think RBI would take cognizance of the fact that there is a demand destruction that is taking place. And if you look at even the PMI numbers, it is clearly showing that there is some erosion in the pricing power of firms because input prices have been rising much faster than output prices. So I think for inflation, I don't think it's a big worry on net basis. On growth, I think we continue to believe that we'll probably be seeing a sub 6% GDP growth for the year. While at this point in time, I think there is sentiment around manufacturing which is still looking positive.
Okay.
We are seeing headwinds from the global growth point of view, but I think domestic demand will be the anchor for this year. If at all that doesn't really pick up, we will be seeing a bigger problem on growth front. And I think we are of the view that domestic demand will remain sluggish. We are seeing rural demand remain tepid. We'll also see probably falling income growth in the urban sector, and also probably profitability of corporate sector also shrinking to some extent.
Yeah,
and more importantly, I think
Madhavi, it's just that the stock market is not listening to us. The stock market is on another plane, and today they are going to absolutely welcome these numbers. Everything is a delta. If the delta is that inflation is lower than expected and growth is slightly higher than expected, tomorrow we have all the makings of positivity, both for the bond markets and for the stock markets. This is a pleasant set of numbers. No taking away from the longer term or the medium term red flags that all of you have put on the table. But for tomorrow, the markets have something to cheer, provided the US doesn't take away what the Indian data has given us. In any case, the bigger data is going to come on Wednesday and Thursday, the PPI and CPI numbers from the US. So I think that will take away the limelight. But for the moment, the state of the economy news from this set of data is positive. Growth better than expected, inflation lower than expected. Thank you very much, Aditi, Nikhil, Rupa, Madhvi and Shivakumar for joining me in this special edition. Going to a break, more news and updates lined up for you.